Hello, I will try to give you some ideas about the project 2. I hope these ideas could be useful for your project. So this is the how the guidance I put up for your project 2. So there are a couple chapters, there are 6 chapters. So let's start from first one, macroeconomic and industrial analysis. You can use my lecture about macroeconomic and industrial analysis as a guidance. If I were you, I would start with the GDP growth rate. See how the GDP growths look like. Let me see. So this is the GDP growth in the couple past quarters. So as you can see, GDP growth is, I would say, around 4 or 5% in the last 10 years or so. So you see the big dip during the COVID and a big spike right after that. So the current quarter's GDP growth was 2.7%. So yeah, I mean, based on this, I don't it doesn't look like there will be like shrinkage. I mean, obviously it could, but at this point there is no sign. So let's look at each component of GDP growth. Let's say what is inflation, interest rates doing, consumer sentiments, non-farm payrolls, initial jobless claims, PMI index, monetary policy, fiscal policy, government spending, trade deficit. So let's see how they look like. So what's this? This is government spending. Sorry. Yeah, this is inflation. So I think inflation was a big concern, still a big concern, especially in June 2022. It was spiked past 8%. That was a concern. As you know, after that, Fed tried to cut interest rates. So the Fed is obviously following a restrictive monetary policy. So the effect of this should be uh, shrinkage in the economic growth. So that means you could expect economic downturn based on this monetary policy. So that helped a little bit, and the interest, so the inflation rate came down a little bit to 6%. But they, as you know, that just yesterday they cut the interest rates, and they will continue to cut at maybe slower pace. So let's look at the consumer sentiments. As you can see, consumer sentiments normally, so normally it hovers around 100. That's the normal level of the index. So it has been down since 2019 March, since the COVID, and never actually climbed back up to the same levels as before. So the consumers are not very optimistic, but at least one positive is it's up since June 2022. So that's where we are. So obviously consumers are not very optimistic, but maybe a slight upward trends. So that tells me that the consumer is going to be very cautious when they are spending money. So what you see here is the change in the government spending. The reason I look at this number is because I want to see what's the fiscal policy of the government. Is it increasing or decreasing, restrictive or expansionary? As you can see here, so recent change in the government spending is positive. So I mean, at least this information tells me that the government is not trying to restrict the economic growth. So this is kind of conflicting with the monetary policy. It seems like, or this could be even normal, as we discussed in the lecture. Sometimes most government spendings is non-discretionary. That means even government wants to change, they cannot change certain spending. I mean, if you if you uh, if you have 100,000 employees, their salaries are not gonna go away. So certain things doesn't change, but at least this information tells me that the government is actually increasing spending rather than decreasing spending. So I don't see any sign of economic slowdown based on this number. So let me see what else now do I have here. So let's look at some jobless claims or this employment numbers. So this is the initial jobless claims. As you know, I try to show you every Friday because this is disclosed on Thursdays. So that tells us how many people filed um, unemployment insurance. So this was very high around July 2022. From that point on, it's kind of declined. So this is very low level right now. So that means not a lot of people are filing for unemployment insurance. So that's a good sign. So again, this tells me that we should not expect any economic slowdown. So I also look at the trade balance. Remember, the last piece of the GDP growth is export minus import. I'm sorry, not GDP, just GDP. So as the export increase, you would expect higher economic growth. If the imports increase, you would expect slower economic growth. So this tells us the export minus import, which is U.S. trade balance. So that's, I mean, naturally in the United States, this always negative. That means the U.S. imports are higher than exports. But at least number seems to be increasing. That means trade deficit shrinks. So that's again tells me good for the economic growth rather than bad. So, all right, what else? So one more thing is what are the producers are doing. So the producers index, that's PMI index. Again, this number seems to be going down. So that's somehow the most negative for economic growth. So from among all the statistics we looked so far. So that's a low number. I mean, normally this number is around 60, 50. So this number is a little bit low right now. It's 47. So that's kind of negative. So that could lead to economic downturn or negative growth. So my overall conclusion so far, based on these numbers, I would say, I mean, again, this is a judgment call. There is no right or wrong. Again, you don't have to copy my judgment, so you can do your own judgment. But based on what I look, I don't see any sure conclusion that the economy is going to shrink. I mean, at this point, I am totally don't have any call, either positive or negative, but I don't see any evidence of that the economy is going to go down. So at least, and most of the variables actually points towards the other direction. So yes, monetary policy is restricted, but fiscal policy doesn't seem to be. And some of the numbers supporting economic growth, some doesn't, a few doesn't. So therefore, my overall conclusion, I would say economy will continue to grow positively. Maybe it's small growth, but it will continue to grow rather than shrink. So that's my that's my call. So let's look at the industry analysis. Uh, so you need to touch on these points: cyclicality of the industry. For example, you are doing analyzing. Uh, you are analyzing Disney, and that industry is entertainment or consumer discretionary, I would say in general. Typically considered a cyclical industry. Um, so it seems cyclical, but I don't think Disney is gonna be affected that much from economic ups and downs. So again, I would say, yeah, it's cyclical, but specifically for Disney, I don't think it's gonna be affected that much. How about broad industry trends? I mean, if I look at the broad industry trends, the trends I see is this business is getting less attractive. Why I say that? Because um, nowadays everyone can do some kind of shows. I mean, people do a lot of TikTok videos, people do a lot of YouTube videos. I mean, for all sort of topics, and there are some good ones because uh, this is an open market, and uh, some people who had never chance to go to in TV, they can start their own shows, and if catches on, so it's much more likely that a lot of talented people will come out of that. So what I'm trying to say here is, uh, people has limited time, uh, so therefore, uh, trying to get that limited time, or trying to convincing people to look at your show is getting more difficult because there are so many choices. So therefore, I think the companies like Disney and other entertainment companies probably gonna have harder and harder time to get that market share that they used to. Uh, when I was growing up, everyone would sit down in one room and watch the same show. We had one channel, so everyone was watching that. So, I mean, imagine those times versus now. I mean, there are much more competition for the time people have. So I would say broad industry trends are not great unless you become part of that somehow. But I think trends are negative, I would say. Industry life cycle, specifically for Disney, I would say life cycle is, I would say, mature, at least in most of their businesses. Even could be even declining. I mean, I could argue for that. So you need to look at the five forces as well, like what in threat of entry, what's the threat of entry, and rivalry between existing competitors. Um, Rivalry between existing competitors are high if there is a limited market share and everybody is competing based on the price. So this typically rivalry would be very high if you are offering this similar products. For example, GM's versus Ford. I mean, similar. No, that's not a very good example. Let's say, okay, Verizon versus AT&T. I mean, uh, pretty much cell phone service is very similar. In the past there was difference because some had a better reception than the other, but nowadays I think this is almost similar service. So therefore, rivalry is very high because they are just competing on the price, nothing else. Um, so pressure from substitute products, that should be obvious for Disney's business, and at least for the entertainment section or movie production. I think there is a lot of substitutes. Nowadays, myself, I try not. I mean, I don't watch any more movies. I mean, there are so many interesting other shows like in YouTube. You can watch how someone build a house. To me, that's more interesting than watching a movie. Bargaining power of buyers. Again, if buyers can change the product without any kind of negative cost, for example, learning a new software or learning something new thing or trying to get a new parts. If that's not the case, uh, buyers have the bargaining power. Bargaining power of suppliers typically driven by the there is a good or commodities that you are the only or limited number of suppliers, or demand is much bigger than suppliers, then you have a power. So you need to look at from that perspective and make a judgment call. So this would be our first chapter, macroeconomic and industrial analysis. A lot of words, but if you touch up on these points, I mean, similar to what I did so far, I think you would be fine in this section. Second part is financial statement and ratio analysis. So here, there are two things you need to do here. One is look at the trend for the company. How is the trend for a good number of ratios, and then also compare at least the last years of ratio of your company with your benchmarks. So let's see how can you do this. So let's say I'm analyzing Apple rather than Disney. So I'm just gonna download the ratios of Apple. By the way, if you go Bloomberg, if you choose financial analysis, and if you choose a custom um, tab, and then you will see that ratios tab. So I'm sorry, you need to go share tab, sorry, not the custom, but share. I shared my ratio tab with you. So you should be able to find already created a table for you with these ratios. So if you include in your analysis these ratios, that would be great, good enough. So that's what I did. I downloaded all the ratios of the company for Apple and Google and Microsoft. Okay. So that's so you see the ratios from 2006 to the today. So and I look at the how does the ratios change over like 2006 to 2023. So it's about 17 years of data. Um, so some ratios, and I put a simple graph here. I think it's really helpful to judge which, I mean, whether there is a positive trend or negative trend. We just do this simple graph here. So let's look at the first ratio. First ratio is total debt to total asset. So total debt to total asset. So as you can see, total debt to total asset ratio increase. So that means the company is getting more debt. I mean, I interpreted that as getting worse. I mean, you don't want too many debts. So therefore, my interpretation is getting worse. The ratio is getting worse. So for example, here is debt ratio is 32%. Here was actually 0 at the beginning. So it started with 8% in 2013, and now they have 32%. So total 32% of assets are financed by debt right now. So I mean, that's to me, I just think that's a negative trend. Some ratios are flat, and most of them are getting worse. So there is some group of ratios that's improving. So what's that improving ratios? So these are mostly in the return margins, or as a group, that's the profitability ratios. So as you can see, for Apple, profitability ratios are improving as a group. And as a group, debt ratios are getting worse. So turnover ratios are getting worse, right? Let's see asset turnover. So asset turnover here is actually says flat, but the remaining turnover ratios are getting worse. That means there is a negative trend. So as a summary, by looking at these ratios, I would just say that I can make a good call what's happening here. Most ratios, especially debt and turnover ratios, are getting worse, but profitability ratios are improving. So that would be my conclusion from financial statement analysis. So at least by doing this ratio analysis. So at least I did a call on the trends in this company's ratios, and now I need to compare this with the ratios of other companies. So I just copied the Apple's ratio, the last 12 months ratios. So that's where I copied this last 12 months. But that means since February, no, I'm sorry, that's last, so 2012 essentially, 2022 essentially, yes, 2022. So this finishes in 2022 September, but this is December. So in 2022, ratios I copied for Apple, and I did the same thing from Google. So as you can see, the last 12 months, same ratios. Microsoft, I copied from the same. So I just put together all these ratios, and then I'm comparing now, for example, what's the total debt to total asset ratio for all these companies. Obviously, I'm analyzing Apple, so I'm comparing Apple's ratio with these companies. So I look at the minimum ratio, because minimum ratio for the debt is the best ratio, right? So minimum ratio is 698. That's Tesla. Tesla has the lowest debt, and um, looks like Apple has the highest debt. Yes, has the, yeah. I mean, this one is Amazon has 33%. So I would say one of the worst ratios for debt is in Apple. So that's not good necessarily. So you just look at each ratio like this and make a call. So again, after looking all these ratios, I mean, there are some good ratios, like for example, this says best. So return on common equity for Apple is 147%. So the maximum among other companies, either rivals, is 39%, which is this one here. Microsoft has 39% return on equity, but Apple beats that, so that I would say this is the best among all these companies. So in general, that kind of in the same line as the trend. Remember, the ratio, I'm sorry, profitability ratios are improving for Apple, and then that kind of shows because of that improvement, Apple has the best uh, profitability ratios among these companies. I mean, this ratios is also good. Inventory turnover, although turnover in the trends were kind of flat, but here is still good. Like accounts receivable turnover and inventory turnover, both are good, and this is the best, which is gross fixed asset turnover. So high debt ratio, but very profitable. So that would be my conclusion. So from this analysis, Apple is doing a great job in profitability. So, but that means they are very good at controlling the cost and be able to charge very high prices. But there is an increasing trend in borrowing. I don't know why, and also, although they still have the good ratios in some turnovers, it's somehow flat and maybe declining. So that's a little bit concern. But the profitability ratios are still improving, so that's good. So Apple is very strong in profitability, but not so strong in others. So that would, this is how could you do a like a financial statement analysis, ratio analysis. So that's what I expect. So if you could use these ratios and make something similar analysis for Disney, that would be great. All right. So let's see. So this was chapter 2. Chapter 3, market-based valuation. So remember we used some multiples here, price earnings, price to book, etc. So I did something similar for these. So again, if you go shared, if you go financial analysis and if you tab shared shared tab, you will find the three statements. So that's another thing that I shared with you guys in the Bloomberg. So you can download this data exactly with the same items that I have here. So all these, if you download that, that's all you need for financial analysis for the rest of the analysis. So as you can see, you have everything here. So you have price to sales ratio, price to earning, price to book, price to free cash flow, enterprise value, EBITDA ratio. So this is all you need. So I downloaded this for Apple, Microsoft, Google, Amazon, Facebook, Nvidia, Tesla. So what I did also, for example, I took Microsoft. I don't need anything else. I just copied these 5 multiples for the last year. So this is the last year. This is a little bit, yeah, last 12 months. So whatever the last 12 months number for these multiples I copied. Same thing from Google, copied, Amazon, etc. So I bring all these together here. So these are my multiples for Microsoft, Google, Amazon, Facebook, all my competitive companies. Again, I'm analyzing Apple. These are my competitors. So these are the multiples from the competitors. So how I'm gonna convert these multiples to the price estimations. So let's do one example. Let's say I'm gonna do price to sales ratio. So price to sales ratio for Microsoft is 13.42. So if I take this number and multiply with the sales per share number of Apple, so I'm taking Microsoft's multiple and I'm multiplying this by the sales per share number from Apple. So I will take 1342 and I'm going to multiply this by sales per share. So you can see 94 is basic revenue, basic share. So let's find that number in the last 12 months. So last 12 months that number was 2188. So I will take 2188 and multiply this by the Microsoft's multiples. So that's gonna give me a price estimate of 293. I will take the same number, revenue basic share, and I will multiply this by the Google's price to sales number. So these gonna be my estimation. So I will do that for all of them. So you see 293, 169, 78, etc. So this row gonna be all estimations using price to sales ratio. So next I will use the price earning ratio. Similarly, I will take the price earning ratio of Microsoft, which is 37. So what do I multiply price earning ratio? Obviously has to be earnings per share, right? So the price earning ratio multiplied by the earnings per share of Apple. So earnings per share of Apple is diluted earnings per share. So let's multiply this number by 562. So that's gonna give me a $213 estimation. Slightly different. Let's see, AB 87. That is price earning ratio plus T12. Did I multiply by T12? Okay, so I multiplied by the estimated, so it makes sense. Yes, I should follow my own advice. So I multiply 573, which is the estimated earnings for Apple, with that multiple. I lost the multiples. Goes all the way down somewhere. Okay. So I will take 573 times Microsoft's price earning ratio. Oops. So that's going to be my first estimation. My second estimation going to be same number, 573. So 573 times Google's price earning ratio. Next, 573 times the Amazon's price earning ratio. So these are my estimates: 217, 179, 365, etc. So my first row is the estimation using price to sales. Second row, my price earning ratio using price earning ratio. So you complete in the similar fashion all these estimates. So now I have 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 6. So I have 30 estimates using this market multiples. So obviously you can, some of them going to be underpriced, some of them are overpriced. So to make an overall conclusion, what I did is I just average by column each of them, and I also average by the row. So, and also I want to be a little bit careful with some outliers. For example, Tesla seems an outlier. You see, if I use Tesla's multiples, my price estimate is 952. But if I use, for example, Facebook or Meta, my price estimation is only 119. 133 if I use Amazon, 131 Google, 188. So these more reasonable to me than the last two. So maybe I will throw the last two. I'm not going to include in the average. That's one thing I could do. Again, let's look at by row. So the price to sales ratio gives me an estimate of 307, 558 using price earning ratio. This seems low. Price to book value and price to free cash flow valuation. Okay, and so I think you can maybe remove Tesla and even maybe Nvidia, and also maybe we can be careful with the price earning ratio. If you exclude this, I think it should be a reasonable number remaining. So yeah, it looks like maybe you should just average those four. Seems more reasonable estimate to me. So let's do that. Let's remove that. actually let's put some, yeah, let's just exclude because it's 0. So I think 170 is the price estimate from market multiples. Current stock price of Apple is 160. I think this seems a reasonable estimation. So that means I would say, yeah, it's slightly overpriced, but I mean, it's pretty close, I would say. So that's gonna be my third chapter, right? So now let's look at dividend discount model. Dividend discount model. So what do you need for this section? So we want to do a simple dividend discount model. At least try to estimate dividends for the next 10 years and then use our the way we teach, learn in the class. So try to use those concepts like constant growth, non-constant growth. So I look at the Bloomberg and I got cost of equity. Maybe I can show you how does that look like. Let's see. Maybe this is looks better maybe. So if you go financial analysis, you should find the weighted average cost of capital section. As you can see, equity cost of equity seems 10.3%, right? 10.3%. That's what I used here. 10.3% here. And also I found the current dividend. Oh, sorry, where is that? No, that's earnings per share. Right now that dividend payout ratio is about 16%, 17%. So right now the dividend is about 17 cents, so it's pretty low. So I can just use some random growth rates. Like right now, growth rate is about 22%. So we can expect this growth rate gonna decrease. Let's say if I decrease the growth rate regularly until we hit 5%. I mean, these are very random stuff. You might say, where do you get this? I mean, I just make some assumptions. I'm just trying to see how it's gonna look like based on different assumptions. So the growth rate would be 17%, 20, so that's etc. So I'm looking at here. So these are dividends. And I discounted and I found a very low price. It doesn't seem very reasonable. So I think I did a couple different approaches. And I did something very detailed oriented. I will talk about that later, but let's do a bit more simplistic assumptions here. So let's say cost of equity 10.3%, current dividend is that's irrelevant. So that's what important here is the earnings per share. And I look at the current return on equity for Apple is about 30%. So I mean, you don't expect the Apple to keep this return on equity at that level. So I'm sure they could maybe keep 5-6 years, but let's say they couldn't. They just kept only 2 years, and then after that the return on equity will decrease to 20%, and then finally it settled at 12%. So let's say my plowback ratio is 80% based on the current payout ratio of 17%. I think I could assume a 20% payout, 80% plowback. So, and then eventually this has to go down. That means they cannot keep plowing back because they're gonna run out of investments opportunities. So Based on the ROE and the plowback ratio, I found these growth rates. So I started with some based on the earnings of 592, and this growth rate, the earnings gonna be $7 next year's $9, etc. And based on that payout ratio of only 20%, he'll pay 20% of 739 as dividend, and the present value of that dividend will be 134. So based on this, I also calculated the terminal value, which is 287. So if I discount back everything, I have an estimation of 133 using dividend discount model. This seems a plausible model, so I could kind of use that. The most detailed model I use is, I'm going to use that also in free cash flow analysis, is I try to create some real statements. Again, I'm going to use this portion in the next chapter as well, so let me go over a little bit what did I do here. So I started with sales, and I look at how the sales changed or revenues change over years. So for example, revenue went from 13,000 to 19,000, and next year 24,000, 37,000. So it's growing very fast. So I computed that growth rate first, because sales growth is the most important variable you have to estimate. So these are the sales growth. Just divide them by the next column with the problem. So this is 1 plus growth. So that means first growth was 38%, that next one is 27%, 52%, 14%, 52% one more time, and 65%. So these are growth rates, and it's pretty high. I found the mean growth rate, which was 22%. That's why I used that 20. I started with that 22% growth. It has been the average growth in the last 16, 17 years. Median growth was 21%, maximum growth was 65%, minimum growth was minus 7%. And I also use a forecast, just to find fit a curve to that 16 years, and then see what will be your forecast next year. 3% forecast seems a little bit unreasonable. I'm assuming they're gonna grow faster. So in this case, it's much more reasonable to use mean, and in some numbers it could be something else. So after I estimated the growth, so I also look at their cost of revenue margin. So what I did here is obvious. I just took the cost of revenue and divide by the revenue. C4 over C3. So C4 over C3. So cost over revenue to find the margin. So the margin is 71% here, 66%, 64, 59, 60, 59, 6, 56, 62, 61, 59. So as you can see, this is a pretty stable number. So the gross profit margin is about 60%. Again, I found the mean, median, maximum, minimum, and forecast. So you want this number to be as high as possible. So the most optimistic number is 71%. No, I'm sorry. You want this number to be small. Sorry. So 56% would be great, because only 56% is the cost of revenue. That means your profit is about 44% here, versus here your profit is only 29%. So I look at the mean, and so I think it's reasonable to use median here, 61%. I kind of did similar things for some important items. For example, what is the net income margin. So it's about 10, 14, 16, 19. So that's net profit margin. Is it stable? 10, 14, 16, 19, 21, 20. As not stable as gross profit margin, but I think around hovering around 20%. Again, you can find the mean and return, mean and median. So 20% here. Mean is 20%, maximum 26, minimum 10%. So obviously also you want this net income margin to be higher rather than lower. So and you can do these ratios for the important balance sheet items as well. So once you determine these ratios, you're going to use these numbers to create your pro forma financial statements. So what is pro forma financial statements? That means you try to create financial statements for the future. So in this data, the last year is 2022. Okay. But I'm estimating numbers for 23, 24, 25, 26. So how do I estimate this? Based on the past. What happened in the past, I'm assuming is going to repeat in the future. So, for example, the last revenue here is 365,000. So I'm taking, not even that, I just use, yes, 365,000, that's R, right? And I'm multiplying this by AA99. What is AA99? The growth, right? So essentially I use a 7% growth, although the mean was 22, median was 21. I'm just once you create your model, you can change that number. Don't I mean, you don't have to stick with 7%, but I just want to put some numbers and work with that number. So I put 7% number and then work with it. So as you can see, I'm always using 7% here. So I'm growing my sales based on that number. So I will work until 2031. So next I will create my cost of revenue. Cost of revenue. How do I create cost of revenue? I'm going to take the revenue I estimate in the first step, and I'm going to use that margin. Remember, margin was about 61%. So let's see, what did I use? AA100. Cost of revenue, I use 61%. As you can see, I use 61%, which was the median gross profit margin. 61.47. That's what I use. So essentially, doing this kind of technique, you can create your pro forma income statement, your pro forma balance sheet, and then you can estimate everything from there. So what is the eventual product of this would be, you're going to estimate your free cash flow using this approach. So here is my free cash flow estimation. I mean, obviously this is complex. By the way, I post this on Blackboard under Toolbox. You can take a look how I did everything. I mean, obviously you're not going to understand by just going over this. So you need to go and see, look at the formula. So this is my free cash flow estimation. And I also estimate the dividends and the earnings. So for example, there's my dividend estimation. Yeah, I estimated diluted earnings per share and my dividends per share. So 0.99, 1.06. And I use that sum here. Yeah, I mean, here is the estimation of dividend per share 106 113, right? 13 121 113 121. So these are the estimates from that section, and using this I found the price 22. Again, as I talked about in dividend discount model, that's not very reasonable. I think I would go with this model. So using the free cash flow valuation, and I could estimate a price. So by the way, this is gonna be your chapter 5. And that estimate is right here. Actually, I also wasn't satisfied with this, and I create some. I mean, you don't have to do this, by the way. This is way too complex, maybe, for this project. I also created some scenarios, like base scenario, optimistic scenario, pessimistic scenario, and you can kind of use that scenarios. So, for example, so cost of revenue, right? Cost of revenue, you want this cost of revenue to be as low as possible. So for example, if my scenario is 1, that means most likely scenario, I use 61%. So if scenario 2, as you can see, I'm using 56%, which is the more optimistic, right? You want this as low as possible. But if you choose scenario 3, that's pessimistic scenario, that's gonna give you the maximum. So I kind of did this for all these assumptions. So I just keep repeating myself. I mean, this finance is not a hard science, it's a more art than science. So don't trust your numbers. I mean, don't have some confidence. You need to be very paranoid almost. So you need to consider all sort of scenarios, and your analysis should be judgment call after you do this analysis. So I have these scenarios are built in. Just don't mess up the model, okay? So if I change the scenario here from 1 to 2, remember 2 was the optimistic scenario right here. So the price estimate is 163, but if I change back to 1, price estimate 152. If I change to the pessimistic scenario number 3, price estimate is going to be only 45. So let's go with the most likely scenario 1. I mean, 152 is pretty reasonable given the stock price right now is 160. Remember, with my dividend discount model, I came up with 133, and with the market multiples, if I exclude all the outliers, I also came about with $150 estimate. And also, you could do very simple free cash flow valuation model. So let's say you are totally don't want to do this something like this. So what you can do is you can simply look at the free cash flow that you get from Bloomberg. So for example, the row 60 is free cash flow, I'm sorry, 61, free cash flow to the equity. So you see this number 105,000 free cash flow to equity. So that's free cash flow available to equity holders. The reason I'm going to use this number because I don't need to calculate weighted average cost of capital, although it's right here. I can just use the cost of equity. So as you can see, I just copied that number here. My cost of equity here. I just assume a growth rate. This is total random. and I estimate a value using these three numbers. So 105 over 10% minus 5%, so it gives me, and finally you have to divide this by the number of shares, obviously. So that gives me another estimate. Let's call this estimate 3. So this is a very simple free cash flow valuation. This one is very complex free cash flow valuation, and this is an estimate from market multiples. Obviously you have an estimate from dividend discount model, so you can average those 3 or 4 if you want to include dividend discount model as well. So by the way, this is a little bit exaggerated because here at market multiples I did not exclude those outliers, but if I use here about $152, remember that's what we came up with. Where was that number? Oh, 109.50. So if I use 151, let's say 151, what is going to be my overall result? Same, okay. Good. So I have 3 estimates. This estimate 1, estimate 2, estimate 3 seems a little bit low from that simple one. So I mean, I could even exclude this as a little bit outlier. So this 2 very close, I would say. I mean, my final price estimation should be around $150. Current stock price is 160. So I would say hold, or even I would say sell, okay, based on this analysis. So that's going to be my final conclusion on this. So you have to summarize everything here. You can just say, okay, from this model I got this price, from this model I got this price. Finally, I average them. This is the number I got. So this stock is overpriced. Sell it, right? So that's gonna conclude your project like that. So I hope this helps. I know certain parts may be complex, but at least you have some idea what to do. So, all right. If you have any question, let me know.